Ever wondered how massive companies with global reach, the kind that seem to dominate every market they touch, can report such low profits? It's a question that often pops up when we see headlines about record revenues, followed by surprisingly small tax contributions. It seems odd, right? How can these behemoths of industry, with their sprawling empires and ubiquitous presence, these giants rake in millions, seemingly effortlessly, even billions, dwarfing the GDP of some small nations? Yet their tax returns look surprisingly lean. The numbers just don't seem to add up at first glance. But this isn't a sign of trouble or some shadowy conspiracy. It's often the result of smart legal financial planning. It's about understanding the rules of the game and playing them to your advantage. Many successful businesses intentionally minimize their taxable income, and they do so quite deliberately. Not by hiding money offshore in some clandestine tax haven, but by mastering the tax code. They know the ins and outs, the loopholes, and the perfectly legal deductions available to them. The government sets the rules, the framework within which businesses operate, and these companies play the game expertly, with a level of sophistication that's often underestimated, ensuring they keep more of their earnings. This allows them to control their own destiny and invest in their future. This strategy lets them reinvest in growth, fueling further expansion and market dominance, hire more people, creating jobs and stimulating the economy, and innovate, pushing the boundaries of technology and creating new products and services, all while reducing their tax bill. It's a virtuous cycle of growth and efficiency. The key is understanding that taxable profit, the number that ends up on the tax return, isn't the same as cash flow or actual wealth. It's a different metric altogether. After accounting for legitimate deductions and expenses, things like research and development costs, depreciation, and other allowable write-offs, reported profits can look much smaller, sometimes significantly so, than the company's real financial strength. The underlying assets and overall value remain robust. This is strategic accounting, a proactive approach to managing finances, making tax laws work for the business, not against it. It's about leveraging the system to achieve your financial goals. So when you see a thriving company, a true powerhouse in its industry with a modest tax bill, don't jump to conclusions. It's not about deception or some hidden agenda. It's about efficiency. It's about making every dollar count and maximizing shareholder value. It's a fundamental part of sophisticated financial management, a skill that separates the good companies from the truly great ones. And it's a lesson every savvy entrepreneur learns early on, the importance of understanding and utilizing the tax code to build a sustainable and successful business. When a U.S. business looks poor on paper, it's not in trouble. It's just using every legal deduction and credit to reduce its taxable income. The U.S. tax code is complex, but it's filled with opportunities for businesses to lower their tax bills. Companies invest in accountants to navigate this maze, not to cheat, but to use the system as designed. Deductions and allowances are there to encourage investment, research, and job creation. A business might show a small profit or even a loss on paper, but that doesn't reflect its cash flow or assets. This is financial engineering within legal boundaries, a feature, not a flaw, of the system. By using these incentives, businesses help themselves and contribute to broader economic goals. It's a win-win even if it looks confusing from the outside. How do businesses look broke on paper but stay successful? They use a toolkit of legal strategies. Claiming business expenses is key. Everything from rent and salaries to marketing and office coffee can be deducted. Depreciation is another tool. Big purchases like machinery are written off over time, reducing taxable income each year. Other deductions include loan interest, pension contributions, R&D credits, and insurance. For LLCs and S corporations, profits and losses pass through to owners' personal tax returns, allowing further tax savings. Smart accounting ties it all together, timing expenses and investments to maximize benefits. For example, making big purchases at year-end can lower that year's profit. It's not about cooking the books. It's about planning and using every legal advantage. The result? Maximum financial efficiency. That's how the best businesses operate. These strategies aren't just for tech giants with sprawling campuses and cutting-edge innovations. They're not exclusive to companies listed on the stock exchange or those with venture capital funding. Small businesses and freelancers, the backbone of our economy, use them too. In fact, these strategies are often even crucial for smaller entities. Take Sarah, a bakery owner, pouring her heart and soul into every cake and pastry. She buys a new state-of-the-art oven to increase her production capacity and improve the quality of her baked goods. and depreciates it over several years, lowering her taxable income each year. This allows her to reinvest those savings back into her business, perhaps by hiring an additional employee or purchasing higher quality ingredients. She meticulously tracks every expense, from flour, sugar, and eggs to staff wages, rent, and utilities, turning everyday operational costs into valuable tax savings. Mark, a freelance designer working from the comfort of his home office, deducts a portion of his home expenses, such as rent or mortgage interest, utilities and insurance, software licenses, design equipment, and even his trusty computer, depreciated over time, reflecting its gradual wear and tear. Every legitimate deduction, no matter how small it may seem, reduces his taxable income, allowing him to keep more of what he earns. It's not about exploiting loopholes or engaging in shady practices, but about diligently applying established tax principles and understanding the rules of the game. Whether you're running a bustling restaurant, providing essential plumbing services, or offering expert consulting, meticulous record-keeping is absolutely key to unlocking these tax benefits. Forming an LLC or limited liability company offers small businesses crucial liability protection, shielding your personal assets from business debts and pass-through taxation, effectively avoiding double taxation on profits, a common pitfall for other business structures. This strategic business structure can make a significant difference in how much hard-earned cash business owners ultimately get to keep in their pockets. The bottom line, smart tax planning benefits businesses of every size, from the smallest startup to the largest corporation. It's not just about minimizing your tax bill, it's about making your money work harder for you, fueling growth, and securing your financial future. Let's be clear, these tax strategies are legal and common practice. There's a big difference between tax avoidance, legal, and tax evasion, illegal. What we're discussing is legitimate tax planning, not breaking the law. Governments design deductions and credits to encourage investment R&D and hiring. When businesses use these, they're following the lawmaker's intent. Think of it like using a supermarket voucher. You're not cheating, just taking an offered deal. Smart businesses know all the vouchers available and use them properly. Accountants ensure compliance and ethical practice, not rule-breaking. So, when you see low profits reported, it's usually smart, compliant planning, not shady dealings. It's the mark of a well-managed business. There's a big difference, a fundamental distinction that often gets overlooked. It's a difference that separates those who truly understand wealth from those who are simply chasing a number. Between taxable income and actual wealth. Taxable income is just the tip of the iceberg, the part that's visible and subject to immediate taxation. Actual wealth, on the other hand, is the massive, often unseen portion that lies beneath the surface, steadily growing and providing long-term security. Taxable income is what's left after deductions. It's profit on paper. It's the figure that dictates your tax obligations for the year. Actual wealth includes cash, property, the tangible assets that hold value over time, equipment and investments, minus debts. It's the net worth, the true measure of your financial standing. A company can show low taxable income, perhaps due to strategic investments or depreciation, but own valuable assets, representing significant underlying strength, like land or buildings, which appreciate in value over the long term. For example, a property developer in the midst of a large project might report a loss after big purchases, such as land acquisition or construction materials, but their assets have grown, with the potential for substantial future gains. A tech startup might reinvest everything, pouring all available funds back into research and development, showing no profit or even a loss in the early stages, but building valuable technology and a strong brand, which are incredibly valuable assets. Investors look at the bigger picture. They understand this dynamic assets and growth, the potential for future profitability, not just reported profits, which can be a temporary snapshot. The same goes for individuals. This principle applies just as much to personal finances. Someone with a modest salary who diligently saves and invests, but valuable property, can be growing wealthier, building equity and long-term financial security, even if their taxable income stays low, perhaps due to deductions or strategic tax planning. Focusing only on reported profits can be misleading, both for businesses and individuals. True financial health is about the whole balance sheet, the assets, the liabilities, and the overall net worth. Not just the tax return, which only reflects a portion of the financial picture. Always look beyond the numbers on paper to understand the true story of wealth and financial well-being. Small business owners, these strategies work for you too. First, keep meticulous records of every business expense. Use software or organized receipts, no records, no deductions. Know what counts as a business expense from supplies to a portion of your home internet. Don't guess. Research or ask a professional. Every legitimate expense claimed means more money for you or your business. Consider your business structure. LLCs and S-Corp can offer tax and liability benefits. Invest in assets that can be depreciated and make pension contributions. They're often tax deductible. Most importantly, invest in good advice. A skilled accountant can save you more than their fee. Smart planning now means more cash and less stress later. In summary, looking broke on paper is about smart, legal tax planning, not deception. By mastering the tax code, businesses keep more earnings to fuel growth and innovation. Taxable income is a legal concept often very different from real profit or cash flow. The best businesses use every deduction from expenses to depreciation to operate efficiently. Small business owners can do the same. Meticulous records, smart structure, and strategic investments make a big difference. The goal: pay only what you owe, not a penny more. This isn't greed, it's responsible management. Smart accounting empowers owners, giving them more control and capital to grow. It's not cheating, it's intelligent use of the system. Hopefully, you now see why successful businesses report low profits and how they do it legally. Tax can be daunting, but understanding expenses, depreciation, and business structure is key. This knowledge helps you make better financial decisions. But remember, tax laws are complex and change often. What works for one business may not fit another, so always consider your unique situation. Don't go it alone. Missing opportunities or making mistakes can be costly. The smartest move? Consult a qualified accountant or tax advisor. They'll help you set up systems, claim deductions, and stay compliant while maximizing savings. With expert help, you can keep more of your hard-earned money and set your business up for lasting success.